Well, Titan's share price started off a little strong, but now it's slowly ebbing towards the red, 1% gone. And from one management to another, we have Blue Star, which reported its first quarter numbers. Lots to discuss, really, especially in terms of demand trends, given the fact that it's the second consecutive peak season that has been hit by, the pandemic. And then, of course, you've got that headwind of high input costs as well. Vir S Advani, the Vice Chairman and Managing Director of Blue Star, joins us now on the show. Good morning, Mr. Advani, and thank you so much for taking out time. Let's start first on the demand front. April-June 2020, we had a very, very stringent lockdown. April-June 2021, we had a severe pandemic and, a lockdown, but not as stringent as the corresponding quarter. But nevertheless, it's your peak season time where you have seen restrictions come by on people, on their spending abilities as well. How have you seen demand hit, and what sort of recovery as well have you seen in these last 30-40 days?
Morning, Aisha. Morning, Nikunj. Thanks for having me. I'll just, I think that the numbers may throw some light to your question. If you look at it, our revenue was grew about 68% over FY21, but was only 67% of FY20. So while we have a good growth over the last year, the recovery as compared to FY20 was only 67%. If you come to our segment 2, which is the summer heavy products, you'll see that there's an 84% growth in revenue, but only a 56% recovery from FY20. So really what's happened in the market is that while so a couple of things. One is, of course, in FY21, in FY22 that we're in right now, the number of days of lockdown were obviously fewer than in FY21. So that was one change. The other is that we were more prepared as an organization to respond and serve the market. So demand did definitely fall, but we were able to capture adequate amount of the recovery as it came back. Also, interestingly, while of course April and May were very tough, June, as things started opening up in the last 2.5 weeks of June, we saw tremendous bounce back in demand. And in fact, July demand has been very strong as well. So I think overall, we're seeing a very good recovery in demand this year as compared to last year.
All right, so good recovery in demand, and I suppose the future outlook as well is looking a little promising. You have, the festive season as well, which will be coming up. Do you think that will be a further booster shot of sorts to this recovery that you are seeing? And how far away are you from, getting all the way back to what you were seeing pre-COVID?
Sure. So maybe I'll talk about the summer products first. So while I explained that there's been a strong recovery, I look at it differently. I look at the opportunity because what happened in the market? The market grew 55% in FY22 in this first quarter as compared to FY21. I know it is not comparable for the reasons we've discussed, but there was a 55% growth. Our room AC business grew 58%, so there was very strong bounce back. How do we see the rest of the year? I think that we are looking at, so what happened in the market? In FY21, the market was about 85% of FY20. So the market degrew 15% for the full year in FY21. Given the bounce back in Q1 and what we're looking at in July and August, we are feeling confident that the room AC market will recover for the full year to FY20 levels. So we'll be back at FY20 pre-COVID levels by the end of this year. Of course, in this year, there'll be a very large Q4 because we lost a certain amount of Q1, but I think that demand momentum is picking up. For the company overall, we are also seeing a similar trend. If you look at our segment 1, which is our B2B businesses, actually Q1 wasn't too bad in the sense that it has recovered to 81% of FY20 levels. So as again, segment 2, which had only recovered about 56%, as I explained to you, segment 1 has recovered 81%. Therefore, for the full year, we should see returning to pre-COVID levels as far as our B2B businesses are concerned. So I think that gives you a sense of how we see the year ahead. Of course, there's one big difference, which is commodity prices. There are headwinds definitely on gross margins as a consequence of that. Costs are going up. You do know that we have increased prices 2 times in this calendar year. Our first increase was in January, where we increased prices 5 to 8%. And there was another increase we did in April, which was about 3 to 5%. Very honestly, we should be looking at a third price increase very soon. We're just holding back because we have inventory from the earlier cost structure. So we aren't yet increasing prices. But I think by the time October comes ahead of Diwali, we will need to see another price increase. So there is some, of course, there's some constraints and concerns around how much the market will accept the price increases. So far, it has. Demand has been somewhat impacted, but not that much. We're still hopeful that the market will absorb these increases because it is a market-wide issue, and that demand will not get impacted too much. We return to pre-COVID levels, having lost 2 years.
Yeah, commodity costs have been a key pressure point, haven't they? But tell me, what is the excess inventory, Vir, currently lying with you as well as your dealers?
So actually, again, very, very happy to tell you that dealer inventory, so all secondary and tertiary inventory is very low. So if I compare even July, so even on today is the 5th of August, so if I compare 5th of August field inventory, that's with dealers and distributors, to August of 2020, there's a big difference. Our channels are not overloaded with inventory, and in fact, things are moving very well. As far as our own inventory is concerned, in the company, our inventory levels are what they were a year ago, which is manageable because of 2 reasons. One is, of course, a product is moving now in the market. We have the festival season coming up. And also you are aware that there's a table change, an energy label table change that comes into effect probably in January 22, which means that we need to clear out this inventory that we have before that. So I think overall inventory levels are very comfortable. I think you'll see from the borrowing and cash flow of the company as well that we're in a very comfortable position. Just to highlight the numbers, in June 30, 2020, our net borrowings were about 428 crores. June 30, 2021, sitting in this year, they've dropped to only 68 crores. Of course, we have gross debt of about 450 crores, which we've kept more as resiliency capital to ensure that we don't face the same challenges we did last year in terms of cash. But in terms of utilization of cash, it is, we're managing it excellently. So I'm not concerned about receivables, inventory, or the debt position.
Leave it at that. Thanks so much for joining us today on ET Now. All the very best for the forthcoming quarters.
Thank you. Thanks.
And on that note, we're going to take a very short break on the show. But coming up next, we have an interview lined up with Bosch Limited. Lots to discuss with them. Stay tuned.